Well, let's get started now on some problems on earnings per share. So we have a number of learning objectives associated with this, and working through them, you need to be have an understanding of how to work through the problems. As I said before, I'm not going to require you to work a comprehensive problem. I remember when I took this chapter, my teacher liked to stump us by giving us a very difficult problem that included all kinds of conversion features and calculations and different points in time and doing it all. And I remember that, and I remember how I hated it, and I never really did understand it. So I'm not going to ask you to do that. Instead, I'm going to ask you to know the effects of different things in by themselves. That is, in a distinct thing, one thing happening or another thing happening, what happens to your earnings per share and what needs to be disclosed. So we're up to learning objectives 4 through 9 here, and probably a bit confusing also, I'll have to admit, because I didn't have the luxury of having a board to write on or to take your questions directly about what I was doing when I made my calculations. So I think this is probably one of the harder modules for me to teach in an online environment. Brief exercise 1913. You notice what I've done here in this problem is that I have put in red non-convertible. So I'm going to change around the problem, and I'm going to discuss how it would change if it was called convertible. Non-convertible preferred shares mean these preferred shares are preferred shares. They aren't going to convert into common stock. That's what they're talking about. It says no dividends were declared on either the preferred or common stock. I really didn't like that expression. I also didn't like the thing that they said the income tax rate is 40%, because really those I find I had a little bit of issues with it, because when you read this, no dividends were declared on either of the preferred or common stock in 2017 or 2018. It's not a matter for us to care whether they were declared, which would mean, I assume they're trying to tell us they're paid. It doesn't matter whether they were paid, whether they're in arrearage or what. All we're going to do is make the calculation. So they put things in the problem that really don't need to be there. All we need to do is take the 2 million times the 8% times the 100 par to figure out what preferred dividends we should subtract from that income. There's no need for us to tell them to tell us anything about the tax rate, because that net income number that they give you, you are to assume that is always after tax. So I would put net income at 426. I would put the dividends at 16. I would get 410 as my numerator. And then the common shares are outstanding would be then 820 common shares. That gives us an EPS of 50 cents per share. Now, this is a simple EPS, and that I mean it's not the fully diluted. It's called basic EPS calculation. So this single calculation is appropriate because we do not have anything that would potentially convert into more common shares. Again, you don't have to assume that the preferred shares were paid or not paid. It's just that calculation. So let's change that problem up a bit, and let's change the preferred stock above into convertible. So if we were to take all that preferred stock and convert it, and I said was convertible into preferred, I should have said convertible into common shares. I wrote that wrong. If the preferred stock was convertible into common shares, then we would be required to calculate fully diluted. Now I said was convertible. I'm not saying that I'm changing the problem and the preferred stock gets converted into common shares. I'm saying that we changed the caption on the preferred stock to say that it was convertible preferred stock. If it's convertible preferred stock, then you are then required to calculate fully diluted. Then you would make an assumption going back to the beginning of the year that you would not have that preferred stock, and in that place you would have common shares. So instead of having 820 in the denominator, you have 2 more common shares out there. And I think we were doing in millions, so it's 822 million, I believe. Net income is going to be the same, but there's a difference because now that we do not have preferred shares, we don't have any preferred dividends to subtract. So the numerator changes, the denominator changes, and our number is 0.518. 0.518 is not less than 0.50, which was our basic number. Therefore, we do not have to report it. Only basic is reported, and basic does not change as a result of changing anything like this in the problem because the fully diluted is a what if. It's a what if something happens. The basic is what did happen. So now what if we changed it again and said only half of the preferred stock was convertible? Well, then you would still have to pay 8 for the dividends because half of the dividends would still have to be paid because half of those preferred shares are still out there. And instead of having 2 common shares going up, you'd only have it go up by 1. So 418 over 821 is 0.508516. This again is greater than 0.50. So the fully diluted, you calculate it, you find out that it does not cause dilution. It is not dilutive, is the way to say it, dilutive, and therefore we do not have to report it. So that's an example of changing a problem and doing it when we have convertible versus non-convertible preferreds. Now we have a stock dividend, and the rule to use with the stock dividend is to look to the left, everything to the left of the date in which you had the dividend declared. It's a stock dividend. Be sure you note it's stock, it's not cash. And you go to the left, everything to the left of it is going to have to be increased by the amount of the stock dividend. In this case, it's a 5%. So your adjustment factor would relate back to things that happened before May 24th. The things that happen after May 24th, such as the June 1st issuance of additional shares, do not need an adjustment factor. And this is really, in this problem, a simple capital structure. There's no preferred shares. We have no preferred dividends. Simple because there's nothing in it that would tell us that it would later potentially become outstanding shares. We don't have to do the fully diluted calculation. The stock dividends are also not preferred dividends, so you have to read carefully on these when you see dividends. Don't just think of the top numerator dividends, but really look into it close to see what it's saying. So the stock dividends will affect our weighted number of shares outstanding prior to the issuance date, and the 72,000 will be the new shares that are issued. There's no adjustment done on the right, as I said. Now, when we go into the problem, the solution is given here. We're going to start, and we are going to say at the beginning they have 900,000. They're going to drop the thousands, I guess, on this problem. So you have 900 times 1.05, and the 5.05 comes from being to the left of the date, and I think I have a drawing in here to show you this. The new shares that are issued, 60,000 in a public offering, happens April 30th. So when you look at that, you know you have all of 4 months of the year there before you do it. And then April 30th would be the same as May 1st, if that's helpful. So you could look at that and say for 8/12 of the year you're going to have an additional 60,000. And then the May 24th thing, you do not calculate the number of additional shares. You go back and you make an adjustment to the original 900,000 and to the 60,000 for 1.05, and that's what you do here and here. Again, this 8/12 is because it happened, I believe, on around May 1st or the end of April. So you have the 8 months remaining when the 60,000 is out there. Now, the 72,000 new shares, come about, I believe, a month later, but this timing is after that stock dividend. And since it's to the right of the line, we are not going to do the 1.05. It's going to be just 1, or, you don't need to do it. And if we add up each one of these, combining them, it's in thousands, I believe, so this would be 1,029,000 in denominator. And the numerator, as we said before, since we do not have any preferred shares at all, we don't have to even think about what the preferred dividend might be, if it's cumulative or not or anything like that. So if you do a representation of it, which I do, I can tell what is happening here. I can tell that I can draw a line here. May 24th is the stock dividend date. We had 900,000 starting from the beginning of the year. We had 60,000 on April 30th. So the line here is on the stock dividend date. Everything to the left of that line needs to be adjusted by 0.05. So take it times 1.05. So that way you have added 5% more shares. Everything to the right of it, you're going to assume the numbers already included, and therefore you do not need an adjustment. The 72,000 shares that you issue on June 1st, those shares are already adjusted for the dividend because they come after the dividend date. Therefore, we do nothing to the things on the right. Might be a little difficult for you to understand why we do it this way, but I'm going to say simply draw a diagram, draw the upright line to either indicate the stock dividend date or a stock split date, and everything to the left of it is going to need an adjustment factor. So we have earnings per share of 64 cents. This one has treasury stock, new shares, stock dividends, and it's going to be 2 years. So this is a comprehensive problem. It's going to bring out a lot of issues that we need to consider. It's still fairly simple because we're not really talking about potential conversion, because you see we have treasury shares, we have stock, common stock itself, but we don't have any potential common shares outstanding. That tells us we don't really have fully diluted to be concerned with. I'm going to again draw a chart, which is the easiest way to look at it, but let's look at this and say we started off with 202,000. We purchased our treasury shares. If you purchase shares and put them in the treasury, what happens to outstanding? You probably remember from our last exam that outstanding is actually issued minus held in treasury. So they're saying 6,000 is treasury, so outstanding must go down. So, excuse me, February sneezes today. February 28th, you're going to have a reduction in the number of outstanding by 6,000. But again, this happens at the 1st of March, the end of February, so you're going to have 10/12ths on that one, right? Then on October 31st, or you could say November 1st, so there'd be 2 months for this one, you're going to sell all of those that you had put into the treasury. So you you took 6,000 off the market, reduced the outstanding, and then you put 6,000 back out there. But these don't zero out. In other words, the effect of the February 23rd, 28th, and October 31st transactions don't zero out when you're looking at weighted averages, because you have to account for the number of months for each of these things. And when you look at the graph, we'll see that. Then on November 30th, we are going to issue 24,000 new shares. On December 31st, there's just a statement here about net income. Again, I don't see preferred shares, so there's no preferred dividend. So we are only going to have to worry in our numerator about the one number, which is the net income. And you notice in 2019, they're going to have net income in that year. The only other thing that's happening in 2019 is you're going to have a stock split. I'm going to talk a little bit about dates. So most of the dates in our problem, it's easy for us to see because we could say February 28th is the same as March 1st, or October 31st is the same as November 1st. And whether we used either one of those numbers, our conclusions would be the same, because I say just kind of use those interchangeably. But when you say January 15th, how do you handle that? Do you count the days? What do you do? Well, this, fortunately for us, is a stock split, and stock splits and stock dividends merely require that we draw lines. So we don't have to really be concerned with if this is a half month or whatever in our calculations, because we're drawing a line when we're doing our chart. So I'm going to go down here a moment. They're going to ask us 2018 earnings per share, 2019 earnings per share. It's going to be basic. We know it's not going to be fully diluted. We're going to have to do. And then they're going to say, what if you compare them? So that's another thing. So I'll put all of this here for 2018 up here. Everything's in thousands. So 400,000 on the top, and then on the bottom, we have 202,000 for the whole year. When we buy back the Treasury on February 28th, our outstanding is going to go down, and it's going to go down by 6,000. Then we are going to continue at this lower number across here until we sell back the Treasury on October 31st. In which case, if you are drawing a graph, you realize, yes, we go back to our 202,000 line, right? However, we keep going here, and then we notice that something else happens on November 30th, and that is that we issue new shares of stock. So for 1 month, basically, we have 24,000 new shares outstanding. Now, this is where I say it's not -6 plus 6, even though it's buying Treasury shares and then sending them back out to the market. It's not a zero game there on the sixes, because it's a fraction of the year that you have to take into account. So when we do this, we find that our denominator is 200, and 400 over 200 gives us $2. And there's a little bit of the explanation of that written over here to the right. Now, the next thing that's happening for us is in 2019. The only thing happens that has any meaning is that we have a stock split adjustment. And as I say here, I think it's probably helpful if you just think it happened at the beginning of the year. It really doesn't matter when it happened, because you just need to go back to the left of the line. So I'm making my line here kind of representing, I think it was January 15th. If you had a number of transactions happening, it would matter where I had that line, because the ones to the left, I would add the stock split adjustment on. The ones on the right, I would not. But since there's nothing else happening here, we're going to start with our number of shares outstanding here, and then put an adjustment factor on it. You say, well, how in the world did you get that number there? That 202 minus 6 plus 24. Why don't you have months in that? The reason is because if we were looking at the number of outstanding shares at the beginning of the year, it is not calculated based on weighted average number of shares. It's calculated based on the number of outstanding shares at the beginning of the year. Outstanding shares would have been the 202,000 we started with at the beginning of 2018. The 6 we put into the treasury and then we sent them back out, and in this example it nets, right? And then we have the 24,000 we issued. So I'm going to say that's 26,000 shares we are going to start with, and it needs to be adjusted for the 2 for the stock split, which makes it 452,000, and they've dropped the thousands here. This is 88 cents. So now I want you to go back and look at what we had in 2018. In 2018, we had net income of 400,000, same net income as we have in 2019. In 2019, the only material thing that really happened in this earnings per share calculation is we had a stock split at the beginning of the year. So what do you suppose we should do, because it's a little misleading? And I believe our answer for 2018 was $2, and in 2019 it's 88 cents. That's sending a really bad signal to investors. It's telling them, wow, you have a problem, right? The earnings per share dropped so dramatically. You have a problem. Well, the reason why it dropped so dramatically was the split. So if we were to put these two financials side by side, and this is what you would do if you were actually doing this for a public firm, you would probably be showing not 2 years but 3 years of comparative data. If you did that, you need to go back and you need to adjust back the number in the previous year. So if you do comparative financials, if you show prior financials, you need to go back and adjust for the stock split. So draw the line. If you're doing 2018, you got to do that too. You got to just adjust it for the stock split. So take what you had in the previous year in 2018 and adjust it for the stock split. And if you adjust it for the stock split, you're going to have $1 compared to 88 cents. If you're comparing $1 to 88 cents, that difference is not nearly so dramatic as comparing $2 to 88 cents. So for every year that you present, you need to go back to the prior years and say, what if the stock split had actually occurred in those previous years? Then what would have happened? It's not as hard as you think it might be. You don't have to go back and recalculate everything for the previous year. All you really have to do is make an adjustment in whatever your total was for the previous year for the weighted average number of shares outstanding. Just adjust that total. You don't have to go into the detail and adjust every single component that goes into the weighted average. You can just adjust the total, okay? And adjusting the total, you would take the previous calculated weighted average number of shares and then multiply by 2, and then you see that's 1. Non-convertible preferred stock with a stock dividend. So again, here we have another confusing thing, because they say we pay dividends on the preferred stock, but we don't say any rules. They don't tell us, they give us $50 par. They tell us how much the value is out there, but it does not give us a percentage on the preferred stock dividends. It says there's a 25% stock dividend on common stock, so that's where we draw the line up and down in our representation of weighted average, but it does not give us a percentage to come up with how much the preferred stockholders should get in terms of their dividends. So when they says 50,000, I think you might just assume it's 50,000 that's calculated to that. So I'm not going to do the graphical representation on this one, because I think it's fairly simple. we have 800,000 in common stock, and we have a 25% dividend on the common stock, and that dividend was done in July. Apparently, there isn't anything else that's really happening, so it's fairly simple what's going on here. Your shares that were outstanding, the 800,000 from the beginning, just need to be adjusted by 1.25. And the preferred dividends, as I said, it was very confusing, but you're to assume that it was 50,000. Now, the point we're making in exercise 1915 is that when you have a loss, it is really going to dramatically affect earnings per share if you're paying preferred dividends. So in this one, we have 8,000 shares of 9.5% 100 par value cumulative non-convertible preferred stock. So non-convertible will tell you that you don't have to do the fully diluted. The cumulative business tells you that that is really the calculation for the preferred amount that you're going to calculate. So you're going to take 8,000 times 9.5 times 100 to get that preferred dividend amount. The 373,000 shares of common stock, it looks like the only other thing that's happening here is they have another 12,000 that's going to get issued on May 31st. And no cash dividends were declared for 2018. Well, it doesn't matter. It doesn't matter, as I said before. We just need to calculate how much that they are due, and by that we're not talking about arrearage or whatever. It's just the amount, that basic calculated amount for the preferred shareholders. But here you can calculate that, and it's minus 76 because we always subtract it. The problem here is when you have the net loss, it's minus 114. It's not a profit, it's a loss. So it compounds the problem. You would have had a reduction in earnings per share for common shareholders because you're paying these, or you're having preferred dividends, right, calculated in there. So that reduces the numerator number, and it gets hit by another whammy here, so to speak, because the net loss is a negative number, which makes it even further reduced. So a double whammy there on the top, and it's a 50-cent per share loss. The bottom it's fairly simple, 373,000 from the very beginning. And so if you were drawing your graph, you show that. And then you're going to show what's going to happen here is the new shares which are issued, the 12,000 shares. Either use May 31st or June 1st, really doesn't matter, to get your 7/12ths on it. And so the point in all this is if you have preferred dividends, it amplifies what I call an earnings per share deficit. This is the complex problem here, and I'm putting it in just so that those of you who want to look at it can look at it. If it helps you to understand how you would work through a problem with fully diluted and multiples of things happening here, that again, the best approach I think to this, I have worked this in class before, is to really start drawing that chart and see what happens. And here, you know, there's 300,000 shares of 8% non-cumulative, non-convertible preferred stock, and then they have a stock dividend happening. The cash dividends business is not so relevant as long as you can go through there and figure out what the preferred shareholders would get. You have shares being sold, you have a repurchase of shares, you have retirements. Now, if shares are actually retired, they're no longer in the issue. You might have remembered that. So income tax rate, I guess, is going to be relevant here because we might have something that's converted where we avoid paying interest. So we also have stock options, and you recall with stock options, you have to figure out if they're going to be exercisable or not. So we all have options here, which are 8,000, and they have a share price here at different points in time, and they tell you what the average price per share of common stock was for different periods of time. And one of the things you do is figure out whether these are exercisable. They wouldn't be exercisable if you find out that the exercise price is higher than the market price. So then they don't become exercisable. Then we have convertible bonds. If you have a convertible bond, this is where we are getting into thinking about saving interest, and that affects net income. And then you're also thinking about having additional shares outstanding. Should have mentioned with the options, what you do is the cash that would come in is going to be used to buy back common stock. So there's going to be a plus and minus on the denominator from that issue. So they are going through this and they're making the calculations, and they're going to say that the options in 2016 are considered exercising because the exercise price is less than the average market price. It makes sense that they would be. And if they were exercised, then they would have an additional amount out there in cash coming in, and they would use the cash to buy back shares. So you're going to have share number going up and share number going down for that. And so over here, calculating net income, preferred dividends, shares, new shares. There's a stock dividend that happened before these two transactions. So in between these two things happening and the retirement happening here, you had a stock dividend sometime in this time zone if you were drawing the chart. When you do the fully diluted earnings per share, you also are going to go back and use this 1.04 adjustment. You're going through assumed exercise of options. You by exercising those options, there's going to be, I think this is in thousands again, 8,000 more shares out there. But the cash is going to be used to purchase treasury stock, which is going to be reducing it by 6. Converting bonds is going to have an effect, and here they're talking about up here saving some money here on our taxes on our interest, because the after-tax effect of it is calculated up there and put in there. I don't know why this is over here and not put over here. What I tend to do when I work through problems like this is I'd say net income is going to change, and it's going to change because we're no longer having to pay interest because we converted those bonds. So this is an example of how you would do it. Now there's a number of factors in here that are happening, and you would, as we said in the PowerPoints, that you need to go through and you need to see the effects and if they are dilutive or not. And so we have all these items which are added down here, and then there's an adjustment at the top, and the adjustment at the top is because of only this conversion of bonds. But you need to think about it and say, do each one of these things taken separately cause earnings per share to go down? And as they do, you need to kind of rank them. Which one has the greatest effect? Which one has a lesser effect? And rank them, and then put them into this formula and come up with a solution that will dilute earnings per share the most. You're really diluting it the most. It seems at odds with what you would want to do, right? But that's the approach. And there's a discussion of how the numbers are calculated, so I'm including this for those of you who are really interested in it. Now let's go to our outline. Typically, executive compensation is tied to performance to compensate or to motivate the individuals. And I said that usually we're talking about directors, we're talking about upper management, CEO, CFO. If you're going to calculate what the total compensation is, you're going to take the fair value of that. And generally, we're talking about stock value on the grant day. However, if it's options, then you're going to use option values. And then it's taking that times the number of shares which would be issued and then dividing it up into the periods of time. And I say expensing of it is generally used with a straight line basis. And the reason why I say that is because if I say straight line, you might think about that stock option problem where we had it in trenches, where we had groups that were vesting in different points in time. And the typical way which I do it, which I believe is quite consistent with GAAP, is to divide it into periods of time, and therefore it's not the same amount of compensation expense for every year. Now, this needs to be spread over the period of time it says in which the services are performed. Well, the services are considered to be performed between the grant date and the vesting date, because that's where the motivation is for the employee to do good things. Because that's the time when they have a potential to affect the stock price. Restricted stock plans are either restricted stock in which are shares that are given or units. It really does not matter whether it's shares or units, as I said before, and the way you do it. When you show this compensation expense, we're saying it's accrued. I'm going to say it's spread over a period of time. Again, the date of the grant to the vesting date. On D, it says, if restricted stock is forfeited, related entries previously made would simply be reversed. I'm going to say, I don't know about that one. I'm not going to include it. I'm not going to ask you about it. I don't think that's right. Stock option plans, by the way, give you a right to purchase a number of shares at a given price, and it's during a given period of time. So with stock options, you have dates. You have the grant date, you have the vested date, and then you also have an expiration date. They don't leave it open forever. So with these dates, and oftentimes the vested dates are several dates with one option. And we talked about that in our problems. The compensation, though, is always measured at the grant date, and you are going to use an option pricing model. So this is the Black-Scholes model. It does not have to be the Black-Scholes model as long as it does what's in D. And I think you also had this within your packet where we talked about the requirements for the model that's used. When options are exercised, the cash is debited for the amount received, and the stock accounts replace the paid-in capital stock options account. So when options are exercised, what's going to happen is cash is going to be coming in. It's going to be coming in equal to that exercise option amount times the number of shares that are going to be purchased. And I have to hesitate there because generally when we look at our options, we said an option was for 1 share. Sometime an option is for 2 shares. So if it's for 2 shares, when you actually do this journal entry for the stock accounts, you have to remember that your common stock account needs to reflect 2 shares instead of 1 share, even though there's 1 option. So be careful there. If the recipients become eligible to exercise their options rather than all at once, but over periods of time, we call these trenches or tranches, then they have graded vesting. I said this was quite common. You can either put them into their groups, which is what we did in the PowerPoint, and we saw that then compensation expense was not the same for every period of time, or you can make it each part equal using some sort of a straight line method. And you also saw, I think, one example where we used a weighted average price and we did it that way. The option values will be different because they are vesting at different points in time, and therefore it will matter. The rule which is in place, though, is that your expense, your cumulative compensation expense for these things must be at least equal to the total vested, okay, at any point in time. And we went through that rule and you had it multiple times shown to you. So employee stock purchase plans, the rule, the number, we keep having these magic numbers, don't we? This is 5%. So if you have this 5% rule, it means that if it's 5%, you just record a debit to cash or credit to par, and then the credit to paid in capital is going to be the difference between market minus par times the number of shares minus that 5%. If, on the other hand, you had a greater amount than that, you are required to put all of it into compensation expense. So you have cash being debited for what they paid, you have the amount being recorded as compensation expense equal to their discount, and so 100% of the value of the stock then shows up in common stock and paid in capital. While we were talking about compensation up here, I made the point several times that when we have equity compensation, contributed capital grows as up until the vesting time. And then at the vesting time, when it vests, what happens is you just see a reclassification. If it's things that have expired, we just reclassified those from paid in capital, I don't know, stock options to now paid in capital expired stock options. If we have it in restricted stock units, we're taking it out of paid in capital restricted stock units and we're putting into other contributed capital accounts. So the point I'm making here is that the time that equity grows with these transactions is up until the vested time, and after that it's mainly a matter of reclassifications. Earnings per share is simply earnings divided by weighted average number of shares, and it's earnings that are available to common shareholders. So if you have what they call a simple capital structure, you're just going to show basic earnings per share because you have nothing there that could be potentially result in more shares of stock, and that is going to be adequate. Then they go through some rules, including the rules of issuing stock and treasury stock. If you can work through the problems, then you understand all these rules, because you have to look at it for the number of months that a thing is outstanding, and you make those calculations based on that. For stock dividends and stock splits, however, you do not put them in there and count the numbers of months. Instead, you put a multiplicative factor in there to adjust for it. For everything in my graphical representation, it was before the stock dividend or stock split. If you're doing comparative financial statements, as we just did in one of our problems, you will need to readjust your earnings per share for previous periods of time for the stock dividend or the stock split that happened in this current year. Okay. And it's talking about treasury. We know how to handle that. Explanation here of why you subtract the preferred dividends is because you need to relate everything back to common shareholders, and it talks about that. Diluted earnings per share. If you have anything that might potentially reduce earnings per share, you need to show both basic and diluted. Now for diluted, it has to actually dilute it. And we went through a problem, and the problem had 0.50 for the original number, I think it was our first problem we worked, brief exercise 1913, and we showed that if we had changed our problem to convertible shares and actually worked through the problem, that our either one of our other options did not really dilute because the number earnings per share didn't go down. Okay, so they talk about the basic things, convertible securities. We pretend that we actually converted as of the beginning of the year. So for the fully diluted calculations or diluted earnings per share, however you want to call it, these calculations are what ifs. And I always wondered, why do we do that? Why do we do all these what ifs? Don't have a great answer for you on that, but we just do. We have for, like I said, probably 40 years. I guess going down here, let's talk about the decision maker's perspective. As I mentioned beginning of this discussion, that it's related to the price earnings ratio, and in a way it represents the market's expectation of future earnings as indicated by current earnings, taking into account analysts' perception of a business growth potential, stability, and relative risk. Another measure then that is also related to this is dividend payout. Stock appreciation rights give the executive or an individual a right to benefit by stock price appreciation without buying the shares. What they're telling you here is, though, that if you have these, if it is considered to be equity if the employer can elect to settle in equity. So if they can settle what they owe you in your stock appreciation right with equity, you handle it as equity. That's all I really need you to know there. You don't need to go to that appendix. Okay, so now we have effectively completed chapter 19, and we'll be going on to chapter